What's going on? This is the first episode of our foundational market series. We're going to be talking about what is the market and who moves it. Right, episode 1. What is the market and who moves it? First of all, the market is, think of it like a big meeting place where buyers and sellers come together to interact. People want to buy things for a low price to sell it for a higher price, and then people want to sell things for a high price to somebody that's willing to buy it at that price. Buyers want to get a good deal, and sellers want to sell something for a high price to make profit. When lots of people want to buy something, the demand for that asset class increases, so the price goes up for it. When a lot of people want to sell something, the price goes down for that asset class, and the supply increases, and people want it anymore, so that asset class starts to go lower. Imagine the market as a giant store, not for toys or candy or anything like that, but for money. Every day, millions of people come here to trade, buyers and sellers shouting back prices back and forth. When they agree on price, a trade happens. That's all a marketplace is where people agree on what something is worth. The market's only purpose is to facilitate transactions and to connect buyers and sellers together efficiently. The origins of trading were marketplaces where people traded spices, silk, and gold. So people used to just trade items together in exchange for an item that was equally as valuable or an item that was of more value. So long ago, not really that long ago, probably like 50 years ago, people were face to face in loud, crowded places called trading pits.
Position quite as well hedged at the end of the day.
They shouted prices, they waved hand signals, and they made deals on the spot, kind of like an auction, for everything from wheat to oil and company shares. So before trading became digital, people were trading in pits. Everything was really chaotic. They would ask for orders, they'd put their ticket up, like, oh, I want to buy, I want to sell. There's all types of crazy shit going on. But now it's not like that. Then phones came along, and traders started yelling into headsets instead of across the room. Next came computers, turning all those shouts into clicks. Now algorithms and AI do all the shouting for us, and millions of trades happen in milliseconds. So all that shouting that was going on back then, it's the same thing, but now imagine that shouting and the fighting between buyers and sellers is just being represented inside candlesticks. So the market became faster, smarter, and more connected, but at its heart, it's the same thing that's always been. It's a place where people come to agree on what something is worth, and one person buys and the other person sells. For every buyer, there must be an equal and opposite seller. At the end of the day, the goal hasn't changed. Just like in any other business, the game is to buy low, buy something at a low price, so that you can sell it for a higher price, or sell something for an expensive price to somebody that's willing to buy it for that price, so that you can make profit on your investment, and then to survive the crowd. So it's just like any other business. You want to buy low and sell high, and you want to sell high and buy low. Tell somebody to sell high to somebody that's willing to, that somebody's willing to pay for that high price that you got. So in trading, it's the same thing. The question is just how do you identify what's a good price for something? How do you identify a low price? How do you identify a high price? All right, now we're gonna get into who moves the market. So who moves the market? The market movers aren't the traders that you see on YouTube. They're institutions, they're liquidity providers, they're banks, hedge funds, algorithms, whose job is to create two-sided flow. They move price to fill orders efficiently, not to manipulate retail traders out of spite, but out of necessity. So the key players of this game of the stock market are, first of all, the liquidity providers, or in other words, the market makers. They supply both buy and sell orders. They profit from the spread, not the direction. So first of all, the market makers, they never lose. They never lose because they're the ones providing the orders. They're profiting from the transaction. So they're not actually putting anything at risk. They're just providing both the buy and the sell orders, and then now they're making a profit on what's in between the buy and the sell, which is the spread. Then we have the smart money, so the institutions, in other words, they accumulate positions quietly, then engineer price moves to trigger retail liquidity. Third, we have retail traders. The retail traders provide the fuel, the stop losses, the breakout orders, and the emotional reactions to provide liquidity for the bigger players. But at the end of the day, the people that's really moving the market are the smart money, are the institutions, right? Because retail traders like ourselves, we don't have enough capital to move the market. We just don't. And the smart money, the institutions, they have billions and billions of dollars, so they manipulate price to go to a certain level. So our goal is to just want to trade with the smart money. If we can trade with these institutions, now we can end up making money. So market makers, what are some examples of market makers? We have, first of all, Citadel Securities, Goldman Sachs. These are examples of the people that's providing the liquidity for everybody else to be able to trade, profiting off the spread. Next up, we have smart money. What are some examples of smart money? We have BlackRock, one of the most powerful companies in America. Then we have Renaissance Tech, Bridgewater. These are all investment companies, big institutions that move the market, that very rarely ever lose. Then we have retail traders, people like me and you, people who trade on Robinhood, Webull, Thinkorswim, just other retail brokerages. So smart money, they can't just hit buy on $1 billion position. Why can't they? That would move the price too fast. So do you know what they do? They wait for price. They wait for places where the chart already has a lot of orders at, and where retail traders have put their stop losses at breakout buy levels and breakout sell levels. So then now when price hits those levels, it triggers orders. That now gives the big players the volume that they need to enter or exit quietly. To most people, it looks like random spikes, but it's just the market doing its job, filling orders where there's enough liquidity at. So now, the logic of price, balance to imbalance. This is a key fundamental way to look at the market. So the logic of price, imbalance to balance. So the price always moves in two states. In imbalance, where there are more buyers than sellers, price moves quickly in one direction. That leaves gaps or imbalances where orders have not been filled yet. And this is important because it's like a footprint. It's like a clue that smart money is leaving, that once we can identify these imbalances, now we can get in on them and we can just trade in line with smart money. And then we have the balance. After a strong move, price usually slows down or pulls back to those unfilled imbalance areas. And this lets new buyers and sellers step into the trade at fair prices again. So the market is always searching for balance, either moving up or down to find enough orders to fill everyone. And then when balance is restored, a new imbalance starts, and then the cycle continues again. The simple truth. So the market isn't emotional or random. It's just a machine that connects people who want to buy with people who want to sell, with liquidity being the engine oil that keeps the engine moving smoothly. Market makers keep the system running. Smart money moves the large orders efficiently, and then the retail traders supply the liquidity that makes everything possible. The price moves because it's constantly searching for liquidity, moving from areas of imbalance to areas of balance, and then over and over again. So that right there is what is the market and who moves it. The next video is going to be very important, so tune in for that. Hope you guys enjoyed the video. Leave a like, subscribe, comment, share this with your friends. I'm going to be giving a lot of free game on this channel, so everybody follow up. Peace out. Tune in.